What is inflation? With everything that's going on with the economy nowadays, everyone is going crazy about how to deal with the situation. From outrageous oil prices to empty shelves and spiking prices of goods and services. You've probably been hearing a lot about inflation, but do we really understand what it is and how it affects the economy? We'll find that out and more in today's video. What is inflation? So what exactly is inflation? In simple words, inflation is the value of a given currency that decreases over time. One way to get a sense of how quickly purchasing power is going down in an economy is to look at how much an average price level of a basket of goods and services in that economy has gone up over a certain amount of time. The general level of prices, which is often expressed as a percentage, has gone up, which means that a unit of currency now buys less than it did in the past. How do we understand inflation? While it is simple to track the price fluctuations of particular things over time, human demands are much more complex. Individuals require a large and diverse range of items, as well as a variety of services in order to live comfortably. Commodities such as food grains, aluminum, fuel, utilities such as power and transport, and services such as healthcare, leisure, and labor are among them. Inflation is basically the term used to describe the overall impact of the price changes across a wide range of goods and services, and it allows for a single value representation of the rise in the price level of goods and services in an economy over time. Let's make it simpler by looking at how inflation has affected the price of a cup of coffee over time. In 1970, if you have $2, you will be able to buy 5 cups of coffee. In 1990, the same $2 would have bought you 3 cups of coffee. In the early 2000s, the same $2 would have bought you 2 cups of coffee. And yes, you get it right. Nowadays, the same $2 can get you a single cup of coffee. Prices rise as a currency loses value, and it can buy fewer products and services. This loss of purchasing power influences the general cost of living for the general people, resulting in a slowdown in economic growth. Economists agree that sustained inflation happens when a country's money supply grows faster than its economic growth. What causes inflation? It's not enough that we can define what inflation is. As responsible citizens, we must also understand what causes inflation, as only then will we be able to comprehend how it affects our daily lives. Pricing and inflation in an economy can be influenced by a variety of factors. Inflation is usually caused by an increase in production cost or a rise in demand for goods and services. For us to better understand what drives it, we'll have to take a look at the 2 types of inflation. But before we continue, go ahead and click the subscribe and like buttons. It takes a lot to make these videos. Your small actions tell YouTube to keep promoting our videos. Tell us in the comment section what you can do to cope with inflation. Thanks. Now back to the video. Cost push inflation. The first type of inflation is called cost push inflation, which happens when prices rise as a result of rising production costs, such as raw materials and wages. The demand for commodities remains constant, while the supply of goods decreases as production costs rise. As a result, the increased production costs are passed on to customers in the form of higher finished goods pricing. Rising commodity prices such as oils and metals are one sign of likely cost-push inflation because they are key manufacturing inputs. Companies that use copper to create their products, for example, may raise their pricing if the price of copper rises. If the product's demand is unrelated to the demand for copper, the company will pass on the increased raw material cost to customers. As a result, customers face increasing prices without a change in demand for the things they consume. Other factors that can drive cost-push inflation are employees' wages and natural disasters such as hurricanes that can kill crops, resulting in a spike in prices. Demand pull inflation. The other type of inflation is called demand pull inflation, which happens when there is a strong customer demand for a product or service. When the demand for a wide range of items increases across an economy, their prices tend to rise. While this is rarely a worry for short-term supply and demand mismatches, sustained demand can ripple through the economy and boost prices for other items, resulting in demand pull inflation. When unemployment is low and wages are rising, consumer confidence becomes high, which leads to increased spending. Economic prosperity has a direct impact on consumer spending in a given economy, which can lead to a surge in product and service demand. The available supply shrinks as demand for a certain commodity or service grows. When there are fewer things available, people are ready to pay more for them, according to the supply and demand economic theory. As a result of demand pull inflation, companies tend to increase the prices of their products. How do we measure inflation? You're probably wondering how economic experts come up with these percentages. The inflation rate is measured using a few different indicators, but the most widely used is the Consumer Price Index, or CPI. It monitors prices for a basket of goods and services in the economy, such as food, automobiles, education, and recreation. Another metric that measures inflation is the Producer Price Index, or PPI, which reports price changes that affect domestic producers, fuel, agriculture products or meats and grains, chemical products, and metals are all included in the PPI. The Consumer Price Index usually reflects the price increases that cause the PPI to surge if they are passed on to consumers. Now the question is, who benefits from this inflation? While inflation provides minimal benefit to consumers, it can provide a boost to investors who hold assets in inflation-affected countries. If energy costs rise, for example, investors who own stock in energy businesses may see their stock values climb as well. Some industries benefit from inflation if they can charge higher prices for their products, as a result of increased demand. Home building companies, for example, can charge greater prices for selling homes if the economy is doing well, and housing demand is high. In a sense, inflation can help businesses boost their pricing power and profit margins. If profit margins are increasing, it suggests that the prices corporations charge for their products are rising faster than production expenses. Additionally, business owners can withhold supply from the market to allow prices to climb to a beneficial level. Companies, on the other hand, can be harmed by inflation if it is caused by an increase in production cost. Companies will be harmed if they are unable to pass on increasing expenses to customers through higher prices. If, for example, overseas competition is unaffected by production cost rises, prices would not need to rise. As a result, American businesses may be forced to absorb higher production costs or risk losing clients to foreign-based businesses. Is inflation something that we can control? Central banks like the U.S. Federal Reserve, ECB, BOJ, and BOE try to manage inflation by slowing down economic activity. This is done by raising or lowering short-term interest rates. Lowering short-term rates encourages banks to borrow from the central bank and each other, expanding the money supply. In turn, banks would lend more to businesses and consumers, boosting expenditure and overall economic growth. Inflation often rises with economic growth. Raising short-term rates discourages borrowing, reduces the money supply, slows economic activity, and controls inflation. Monetary policy is the control of the money supply by central banks. Monetary policy is usually implemented by raising or reducing interest rates. A central bank can, however, tighten reserve requirements. In addition to central bank deposits, banks must have cash on hand. Raising reserve requirements limits bank lending capacity, decreasing economic activity, whereas lowering them often promotes it. Does it affect investment returns? Inflation is a silent threat to investors, since it erodes actual savings and returns. Everyone wants to improve their purchasing power. To improve real buying power, investment returns must first maintain pace with inflation. For example, a 2% return before inflation in a 3% inflation environment becomes a 1% return after inflation. Inflation can also affect fixed income returns if investors do not protect their portfolios. Many investors buy fixed income instruments to provide a steady income stream from interest or coupon payments. Because most fixed income assets pay the same rate of interest until maturity, The buying power of interest payments falls as inflation rises. Similarly, rising inflation erodes the principal value of fixed income assets. Assume an investor buys a $100 5-year bond with a 3% annual inflation rate. The principal will be worth around $83 throughout the 5-year period of the bond.